If your childhood was anything like mine, then the advice given to you about credit was don't use it, don't touch it, don't look at it, don't get debt, and you'll be fine. Pay everything cash. Who has money for that? In this episode, I'm going to tell you why all that's a lie.
Sounds better.
What's up?
Yo.
Welcome back, everybody, to the second episode of Minding Your Business. On the last episode, we spoke about money as a tool. We spoke about money as a language, the exchange of it at least. I want to change the perspective for you as to how you handle money, but I also want to show you some of the other tools that you have in your financial profile towards your financial success and financial freedom. In this episode, we're going to talk about credit. Credit is one of the most underutilized tools for the average American right now. It's a tool that gives you the opportunity to be able to lend and borrow and show your worthiness to people who have the money. That's going to help you make more money. I wish it didn't have to be that way, but it is. And quite frankly, once you understand what you're trying to do with this and how it's graded and how it's judged, it's going to be an even better opportunity for you to maximize on this tool. I want to talk about three things on this episode. One, we're going to talk about what is credit, just a general overarching view of what it is and what it does. Two, I want to talk about why is credit score so important? And three, I want to talk about what things your credit score can do for you. Your credit score is the official scoring mechanism used in the United States for judging your credit worthiness. There are three credit bureaus that monitor that score for you. The three credit bureaus in America are Equifax, TransUnion, and Experian. They have their own various algorithms and mathematical equations for the things they do to display these scores for the lenders that you're seeking loans from. At the end of the day, this score is their representation of your financial profile to say how good of a borrower you are and how well you manage money that's lent to you. The different types of scores, well, there are many different types of scores, but the one I want to focus on in this episode is the Fico Score. The Fico Score is the most common one you're going to see. It's the most general one for the things people come to me and talk about all the time. The score ranges from a 300 to an 850. And quite frankly, it doesn't really matter what other people have. I don't want you to pay attention to any statistics. I want to focus on your score and how we're going to improve it. The components for your score are 1, payment history. Payment history is huge. It equates to 35% of your credit score. Credit history represents how effective you are at making your payments on time. Credit history is a big one because not only is it a heavy weighted score, but it's something you can't easily change or easily fix. If I'm looking at your credit worthiness for the last 5 years, you can't go back to 2 years ago when you made 6 late payments on something. That history is always going to be there. The second most heavily weighted portion of your FICO score is the amounts owed. It constitutes for 30% of your credit score. It's a representation of what you owe versus what lenders are willing to lend you. It's generally tracked based on how much credit you've utilized and how much credit you have as a limit. Most people tend to actually believe that the best way to maximize this score is to carry a zero balance. On the contrary, it's actually not. You want to be under what I call the golden rule of 30%. Your ratio of how much debt you're carrying versus how much allowable spend the creditors are willing to give you. Let's do some round numbers, right? If you have 2 cards that equate to $10,000 of credit limit, no matter how many cards it's spread across, you never want to be above $3,000. The magic number you want to stay with is 30% or less. That's the range that's going to give you the best growth in your credit score, and it's going to give you the strongest number in this 30% department that we're talking about. The third component of your FICO score that I want to mention is worth 15%, and it's composed of your length of history on your credit report. So essentially, every item on your credit history has a time that it's been there, from if it's a 7-year car loan, it's been there for 5 years, or a credit card that you just applied for last month. This length of history is going to average those out. The important thing about this one to remember is that you can't fake it. You have to start sooner than later, and you don't want to wait for the time you're going to need it. The time you need a car loan is not the time to start working on your length of history. The time to work on this one is now or yesterday. So get it started and think about that one. Last two segments are the same weight, and one of them is your mix of credit, which is 10%. The mix of credit is literally just that. Different types of credit represent different weights in your score, and you want to have a diversified portfolio to a lender to look the most effective. So essentially, a student loan, a car loan, a mortgage, they're all different types, and you want to have a few different kinds instead of just all credit cards. New credit is the most self-explanatory. It's 10%, and they just want to see that you have new things active and open. You got to kind of balance that out. If you're doing everything else well, this 10% column is going to be just fine. The last thing I want to talk about that focuses specifically to the score are these two negative components. They can't help you in any way, but they can definitely hurt you. The first one is the derogatory marks. These are things that creditors are going to put as a permanent mark on your report that say things like grievances or claims that are beyond the original loan terms. So if they're pursuing you for collections on something, that's going to be a derogatory mark, or a late payment beyond 90 days. These are the things that they're always going to haunt you. If you don't fix them when they're happening or prior to that, they're going to stay there. And unfortunately, you've already impacted some of these other components we spoke about if you have any of these. So deal with the creditors directly, give them a call, start making payments, even if it's $20 a month. Make it happen, because until you start rectifying these derogatory marks, they're always going to negatively impact you. And the last one is something that a lot of people put way too much emphasis on. It does have some effect, but it's not as bad as people think, and it's the hard inquiries. The best way to compete against hard inquiries is to know your score before you go apply for a loan. Pay attention to what your score is with some of the tools we're going to be talking about, and you'll know what you need to be doing, and you won't be applying for loans arbitrarily or without regard to what your score is. With all that, I just remembered it's time for coffee. Oh. Credit is not scary. Just like everything else, once you learn this a little bit, it's going to become like second nature, and you'll see how valuable and how important it is, especially if you like, comment, and subscribe. Don't forget to click that little bell for notifications. I'm going to be dropping way more gems, way more hints, and plenty of tools for you guys to keep using and benefit from. It seems everyone that I talk finances to wants to tell me about their goals for generational wealth, leaving their 9-to-5, early retirement, financial freedom, passive income. All of these are great things. I want everyone watching this to achieve those things. Trust and believe. The name of the game to get to any of those is growth. You need to be able to grow at a time that's different and difficult and with unwavering doubt, bigger than what you would do as a single person with one stream of income. Credit is one of the things that's going to allow you to do that. If you're going to develop money to work for you, you need to get more money than that one stream of income, unless that stream of income is big enough to develop other streams of income. So let's break it down. As lenders go, you need to be able to provide one of two things to be able to be given someone else's money with the trust that you'll be able to pay it back plus interest. One would be collateral, some kind of exchange for this debt, right? You're going to give something up that has value that they're going to give you money for and expect you to pay that money back, or they keep your item. This is generally pretty risky. I don't recommend it because I like the things that I have. I've worked for them. I got them for a reason. So if I'm giving that up with the hopes of getting more money, I have to live without that item. I have to determine a value or a price, which generally they're going to try to undercut you because they want to make something at the end of the day. So there's a risk and a reward for the lender. Again, not advocating any of that, but the second piece is free. It's creditworthiness. I say it's free because if you follow the tools and steps that we're talking about on this episode here, you'll be able to maximize your own score, which shows people on their system, hey, this is somebody that is worth lending the money to. You do that right, and they will absolutely hand you the money in a loan, in early investment, or give you lending power to be able to buy things that you need to continue to grow your portfolio. So keep that in mind. It's always easier to spend someone else's money than your own. If you're paying attention to how you're going to need to repay that money, you're putting that money to work for you. There are many perks to having good credit. Right off the bat, loan approvals are huge. All right. People with bad credit will tell you otherwise, and that's fine. Let them live that life. But understand that every time you walk into a bank, every time you walk into a car dealership, you know you're going to get approved. You're just thinking about what kind of rates they're going to give you and what other things are going to come with that. It's a totally different feeling walking into a place when you know you'll get approved for that loan. Trust me, I know. When you're thinking about these things, the other thing I want you to think about is you're getting better interest rates. So that means lenders are fighting and chomping at the bit to be able to lend you money because they see that creditworthiness. It's actually kind of inverse to how a lot of people think about it. If you're showing a better score, you're a much more worthy candidate to do good with this money that they're lending you. So because of that competition, they're all going to work on charging you a lower interest rate. So it's in your benefit. Some of the other things people don't think about are utilities, insurance. These are all things that are actually going to cost you less because they see more financial responsibility and show that credit worthiness to be able to give you those more competitive rates. So think about that. Keep that in mind. Your credit score is something that you can always work on, not just when you need it. On the next episode, I've got 6 of my favorite hacks for you guys when it comes to credit score. Some of these things are going to give you long-term boosts, and some are even going to give you those quick short-term boosts just to get that loan approval that you're looking for. But these are 6 things that I've actually tried, I know work, and have helped friends and family for me, and I can't wait to share them with you guys. So please don't forget, like, comment, subscribe, and hit that little bell for the notifications so that YouTube knows and I know that you guys want more of what I'm putting together. And last but not least, before you guys sign off, don't forget, dreams are nothing without goals.